I'm Tom from AZTEC Protocol. I'm one of the co-founders. And I'm not really going to talk much about privacy today at all. I set myself the task of talking on money, credit, and cryptocurrencies. And I won't mention too much about utility tokens because they upset me, but I think we're beyond that now. So I'm going to start off just talking a little bit about what money is and what good money is. I'm going to start with this quote, which is relatively up to date. This is Tim Draper speaking in May 2019, and he says the following. It's going to keep going because I believe that in 4 years, something like that, Bitcoin, will be about a 5% market share of the earth. I eventually want to have a fund where I take in Bitcoin and I fund everybody in Bitcoin, because I would then require no accounting, no legal, no bookkeeping, no custody. It'll all be done. So aside from that last bit, which we may have some question marks over, I want to really question the crypto bull thesis, particularly in respect of whether crypto is good money, which I suspect if you're a crypto bull, you really don't think it is, and I'll explain why. So just to go right the way back to the beginning, what is M0? What is fiat currency? The benefits of it is that it reduces order n-squared trading pairs. In other words, if we've got n goods in the economy, I would have ordinarily n-squared trading pairs, and lots of them would be illiquid, and it reduces them to order n. And it gives me price stability, which allows me to create credit systems. So I know this is all completely basic and sucking eggs, but I might as well state them. The costs are, well, number one, there is an article of faith. There is this kind of unimpeachable assumption that I make about the value of a dollar, or a euro, or sterling, or maybe not sterling these days. But I have an article of faith governing my belief in these systems, and I do so just for pragmatic reasons. It's terrible capital. An asset with no economic content is not good capital. It doesn't back the economy. It doesn't help to price the economy. But it's a very useful thing to reduce down the number of trading pairs in the economy and to be able to create systems of credit. There comes a point at which we stop believing these things, though, and Japan is starting to do a pretty good job of this. Their monetary base, the assets on their central bank's balance sheet, are now in excess of GDP. So there's no number at which this stops being a good idea, but the average around the world, I think, is between 20 and 25%. So this is fairly punchy. And as I said just before, this is bad capital. It doesn't back anything. It's a working assumption that allows us to do other things. So quick reminder of why we abandoned gold. There were two things. It was supply shocks and then people wanting to get their hands on it at scary times. So there were periodically discoveries of gold, which led to significant price drops. And in 1933, everyone ran for the banks, very like with the Northern Rock situation over here, or when repos expired at Lehman Brothers, and they wanted to go in and get their liquidity, and they couldn't. So you have these kind of liquidity crises. So that's why we don't like gold, because when you suddenly find a load of gold, the price drops, and when everyone wants to get their hands on it, they'll not only drain liquidity from the banks, but they'll also cause a price appreciation in the gold, and that causes deflation. So this actually is a stolen quote. It's actually stolen twice. Once in that it's generally stolen for lots of different uses, and the second is that I saw this on Twitter somewhere the other day and annoyingly didn't take down who it was, but I'm pretty sure Evan Van Ness retweeted it, is all I can remember. So price stability in a currency, some people call it manipulation, some people call it a feature. It's not a bug. What we want for a really good system of credit is for the price of the underlying sort of money in circulation to pretty well, fairly closely track the goods in the economy. And so we want quite a lot of price stability so that we can stably issue credit onto these systems. So the way that this is done is through two principal devices. You've got kind of open market operations, where the Fed uses its balance sheet to kind of set the short end of the yield curve, and then you can sort of tighten up credit further along the curve by sort of buying junk. So I'm going to actually bury a little bit into the Bank of England's balance sheet, because it's quite interesting, both for crypto people, but also for people who want to know a bit about the money economy. The ECB is basically buying everything at this point. They're buying bonds, high-yield bonds, we used to call them junk bonds. And frankly, other central banks are buying tables and chairs at this stage. So it's becoming a slightly scary place, the monetary economy. So use it to stimulate growth, control inflation. The ECB is about to cut rates further, and they've now gone so far that there's a Danish bank that's actually started issuing negative yielding mortgages at 75% LTVs, which should scare us all. But again, there's no negative numbers are fairly ample in supply, and there's probably no number to which we can't go before someone yells panic. So what's central bank money? Does anyone actually think that they know what functionally central bank money is? Obviously, it's something at the central bank, but I don't know whether anyone knows exactly what reserves that the central bank are principally made up of. And when I say reserves, I really mean kind of the deposits that the banks principally hold. But it is a form of credit. So it's a form of credit, but the one odd thing about central bank credit is it's the one credit you can't question. So this is not like credit at a bank, which I can panic about. So I can have a Northern Rock type run, which we had in the UK, or I can have I can panic about my repos at Lehman's. But you're not allowed to question this credit, or at least if you do, the monetary base has been undermined in some way. Now, I actually found this particular example partly because of where I live, but also partly because the weaponry that is used to supply credit to the UK economy through our central banks was actually alluded to in a very important article written by the Times on, I think it's the 3rd of January 2009, which is referred to in the Bitcoin Genesis blog. And this was the creation of a thing called the APF Fund Limited. The APF Fund Limited is a beneficiary of a £473 billion loan from the Bank of England, and it's being used exclusively, or mostly, to buy gilts. So it's bought the Bank of England debt. And even more perniciously, what's happening is that the income that's accruing on that debt is actually being paid back to the UK Treasury. So this is tantamount to a functional cancellation of a third of the UK national debt. And this is not unique, by the way, to the UK. A lot of people have sort of various systems. A lot of central banks have various systems in place to tighten the returns on credit, so that their governments are not going to be paying high interest bills. But if you look under the hood of the central bank in the UK, this is what you get. So what are the benefits of crypto as a potential M0 replacement, which a lot of people are talking about, both issuers of the native currencies on blockchains, but also people issuing utility coins at one point, utility tokens, thought that they might be able to have supplementary M0 systems. So in favor, there's definitely a supply gap. So that's the kind of tick against those kind of, burying in the Black Hills of Dakota and looking for more gold. You can't really do that. And of course, you can transmit very easily and store in bulk. Against this, it's still susceptible to runs. So you could still have kind of panics where people want to go and recover all their crypto, and the value of that crypto goes up, and then you're back into a deflationary spiral again. So if you are a crypto bull, you do not, for purposes of creating credit systems that make that money actually useful, you don't want this to be money. You don't want this to be base money. Because as soon as it becomes, now that doesn't mean it can't act, by the way, as collateral for lending systems like in MakerDAO, for example. But you don't want it to be the reference asset. You don't want it to be M0. So you can't have both, in other words. So the quote we heard at the beginning was sort of really aspiring to both the gold thesis and the M0 thesis. And not both those things can hold at the same time. It is conceivable that in very, 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 very long run, we could start to rely on something like Bitcoin or Ether as it starts to price stabilize. But at that point, the very people who are buying it now for its price appreciation probably won't hold it in the same bulk. They'll want to hold credits in which are denominated in that M0. I'm not going to say a lot about Libra. A lot of people walking around saying, oh, this might be a new base money. It really can't be a base money. And the reason is that as soon as someone says this is not attached to the major currencies on which it's referenced, as soon as someone makes that claim, its value is lost before it can achieve kind of price stability against those currencies, right? So it needs to hold a peg, and therefore it can't be regarded as the new currency in which you have faith. What could maybe happen with Libra, and I just want to kind of allude to it because I think it's quite interesting, is the monthly, the people who log into Facebook at least once a month are about 2.4 billion. If you make the very generous assumption that they're going to hold, let's say, $100 inside the Libra system, you can get to a calculation that Libra is essentially governing capital flows for 0.5% of the global deposit base. So they can sort of go to banks or whichever, they might be holding sovereign bonds or whatever, and say to them, actually, I'm going to lean on you because I'm carrying so much capital in my system, I'm going to lean on you for a better deal. Now, that might actually be a good thing, but it means that they're also directing where your capital is going into the real economy. So that's, but I don't have strong opinions on Libra. I'm sure they'll do a great job of rolling it out. So the question is, should central banks tokenize? This has been talked about by quite a lot of people, and actually there are sort of there are lots of active voices in this, but Mark Carney of the Bank of England, our outgoing Canadian governor of the Bank of England, said a new digital currency would dampen the domineering influence of the dollar on global trade. So that's really, for him there's a monetary rationale for sort of emancipating us from reliance on the dollar. The People's Bank of China is repeatedly very, very close to digitizing their currency. And there was an interesting allusion to the Bloomberg article on this. I don't know how many of you saw it, but there was an interesting allusion to having to help people to understand the difference between digital base money and digital deposits, which are functionally very, very different. And my view is that observation could be a reason why central banks may find it very difficult to roll out base currencies. And here's why. We live in a world of very low interest rates. Right, so you don't get interest rates on currency, and this will be digital currency. And your bank is giving you, well, actually, I'll show it later. I do a little walkthrough of Wells Fargo. Your bank's giving you maybe 0.5%. So you don't care that much about the yield you're getting on base money versus a deposit in the bank, right? But if you can hold, suddenly, currency, digital currency, you can hold it now as securely or more securely than your bank balance. What are we all going to decide to do with our funds? We're going to start banking with the central bank. So they're either going to have to control capital flows in some way and stop us from doing this, but if they don't, this could actually provoke a run on the banks. So that all sounds a little bit alarmist, but that's how you and I will behave. The flip side is we're going to have to really pressure those banks into giving us an amazing interest rate to make us stick with them. And that will itself reduce the amount of credit that will be available in the economy, because the narrower that interest rate gets, the less the banks can afford to leverage themselves up, right? So they can't provide as much credit to the economy. So this actually might prove a real issue, unless you've got some other mechanism for capital controls, a real issue in rolling out central bank money as digital, as cryptocurrency. So I thought I'd just allude to that. You're probably all aware of how money is created, so I won't go into it too much, but most of it's created away from the central bank. So mostly in credit. That's why it's so important that if a currency is going to be really useful, it's very price stable, because that's what allows you and the bank to perform a swap. So here I create, depending on how you class money, I create $200 of money. I go to the bank and I say, give me a mortgage, and they say, okay, I owe you $100 at 0% tomorrow, which is your deposit. They obviously don't have that in cash on their balance sheet. They have maybe a third or a quarter of that. And you say in return, okay, I'll pay you $100 in 10 years at 5%. And that's a much less liquid instrument. So the bank's thing is really liquid because you can call on it tomorrow, because everyone knows who that bank is, etc. So you can go and spend it in the economy. Yours can't be shopped in the economy in the same way. And it's going to be much more volatile in terms of its price. So the good bits about what the banks do, and they do some good things, credit on demand, that credit is spendable in the shops, and they have risk models to make sure stuff isn't going wrong. The bad bits is that they're playing quite a dangerous game, and they always have done, and that's their business model. Okay, so they convert the IOU tomorrow into IOU in 10 years. They do that transformation, they collect the difference between the interest rates, and they take that risk. And if something goes wrong with the economy, their asset is going to fall a lot more than their liabilities as they get wiped out. So that's always the risk that you're running as a bank. They also have done a lot of interbank lending, which feels like a sort of fairly pointless exercise if you look at it globally. I mean, for an individual bank, it probably makes some sense, a lot of sense, which is why they do it. But I think if we're going to try and redesign elements of the banking system through DeFi models, we need to make sure that banks aren't lending to banks, because that's where unnecessary complication is introduced. So for later on, I just want to remind everyone, why is a deposit stable? First of all, because you've got a claim on a pile of assets, and that claim is quite senior. So if something goes wrong, the assets have to fall a lot in value before you lose money. There's relatively low volatility on the assets that back your bank account, right? So that's really important. They pool these assets, and they're relatively quite safe, and often not hugely liquid, but their price fluctuations won't be huge. In theory, you can redeem it on demand as long as you don't all come at once. And then there's the cheat answer, which is deposit protection, which I think is actually a really bad thing because it sounds like a good thing. But actually, deposit protection turns us all into quite sort of infantile people. We think that we can just sort of have price stability at all costs, and the government will bail us out if we make a bad bet. And really, what that's doing is adding to government debt. So finally, on the real banking system, last two slides. Here's how Wells Fargo makes its money. I hope it's quite useful, just kind of fly through of physically what's a real bank doing. And I say real bank, so I'm not including kind of Goldman and all these people, because they have decentralized a little bit, not much, but they don't principally hold, or they don't hold a lot of the assets that are actually deployed in the economy now. There's this shadow banking industry that's sprung up that actually holds those assets. And Goldman now has increasingly become a place where those assets are created and then shifted off the balance sheet. Wells Fargo is still a lender. Still, it offers you a deposit, and it lends back to you at a higher rate. So credit cards at 12.5%. You've got auto loans. A lot of people getting quite worried about those nowadays. Residential mortgages, commercial mortgages, and deposits at other banks, which again seems a bit cyclic, but that's there for kind of liquidity purposes. So they get an interest income of just under 4%. They have some funding costs. Look how cheap those deposits are. And they get out what's called a net interest margin. So they're getting sort of 2.9 cents on every dollar that they have outstanding. Okay, so when you hear about the money multiplier, this is sort of what we mean, which is how much in deposits is being created by the cash. One of these numbers is wrong, by the way, but by the cash on the balance sheet. So how much cash is supporting the savings that you actually have. And in this case, it's around about 3 times the deposits of $1.4 billion $1.4 trillion on this balance sheet. That should not be 1380M, it should be 1380BN. That's all I really want to say about this, but the reason these are quite interesting numbers is when we look at DeFi systems, we probably want to see kind of similar leverage ratios coming through to make sure that we can serve enough credit in the DeFi economy. So, what should a tier 1 DeFi system look like? There are certain things it should do and probably certain things that it shouldn't do. It should hold collateral. These are smart contracts after all. It should help to somehow provide a mechanism for pooling the risk of that collateral to the extent that it's providing us with a stable coin. So that collateral is being put in. Yes, someone's borrowing funds, but the flip side of that is it should be, this is not true of Compound, but it should be providing us with a stable coin that we can go and spend in the shops and where we can store value like a bank account. It needs to create mechanisms for price injection, but not actually take a view on price itself. It needs to find ways of farming that out to other people. It needs to assess governance risk, which of course MakerDAO does, and I'm going to do a quick study of MakerDAO now. And needs to underwrite. So the Maker token is an insurance contract, essentially, or will be when multi-collateral DAI comes out. It's an insurance contract that means that if all of those leverage positions sitting inside the MakerDAO system, if a load of them fail, there's someone to step in and say, well, actually, we got our governance wrong. We should, so they're really like the board of governors at a bank, maybe is the best way to put it. On the right-hand side, you've got kind of execution prices and and stake, which I'm going to propose as a model for introducing illiquid assets into these systems. So quick case study on MakerDAO. What is it? Some people say it's a central bank. It is not a central bank. It is definitely not a central bank. It doesn't have its own... that's not a criticism of MakerDAO, by the way. MakerDAO is brilliant. It's the one really successful attempt at a monetary system running. But it's definitely not a central bank. It is... Everything's spelt in dollars. I've heard it also called, even by people in the know, a 100% plus reserve system. It's over-collateralized, but so is everything, right? There is not... I mean, if there are banks in the world that are under-collateralized, then don't put your money there. But this is an excess collateral system like every bank in the world. I need more assets than the bank is borrowing to provide everyone with bank accounts, right? And someone collects a profit out of doing that exercise. But it's definitely not a reserve system. In other words, it doesn't hold real dollars. And I don't think the plan is, if there is anyone from MakerDAO in the audience who wants to tell me that actually they're about to start open market operations with the Fed, I'd love to hear it, but I don't think that's going to happen. Not in the short term, anyway. But it's verifiably a tier 1 DeFi system, and is subscribing to some of these requirements. And it's a very grown-up way to do price stability. There's no government protection on this stuff. You have a number of ways of protecting the value of DAI. The first one is excess collateral. And the second one is, if the Maker token holders are irresponsible in some way, they will pick up the tab. So if you run out of equity in your CDPs. There's one really clever thing about, well, there are many clever things about MakerDAO, but there's one very clever thing, which it can't actually suffer a run as it's currently built. So a run on the bank is where I've got a bank account, so a bit like holding some DAI, and I go to the bank and I say, give me my cash now. You actually can't do that unless you're a borrower from the MakerDAO system. So you have to actually already have a CDP to go and redeem your DAI. That's actually quite a clever protection against a run on the bank. It means that there's maybe a little bit more of a struggle keeping the DAI pegged at $1, but it's a very, very clever way to protect against a run on the system. So there's shared security across all positions. So, right, so if I open up a CDP, if I'm going to be a borrower to the system, I put in my Ether, say $100 of Ether, I take out, let's say, $50 of DAI, and I can go and sell that in the market. I'm now responsible for the loss on that CDP position, and I'm helping to support price support in the network. And someone who holds a DAI knows that they have two ways to recover their dollar. Or at least there are two levels of protection. One is all those people who are taking out leverage, and they can lose their equity. And the second is the Maker token holders will step in and make up the cost if there are further losses. So, and that's it. I mean, that's a really sensible way of building a stable coin. There's a difficulty with this DAI thing, which is because you can't redeem anything, quite a small number of people can help to hold that peg in place. Right, so you've got secondary markets in which DAI can trade, but unlike with a bank account, I can go and get cash out of the machine, which is going to reduce the bank's liquidity. With Maker, I can't do that, and it's great protection for Maker, but also it means that only a slender class of people, namely the borrowers, can go and redeem their DAI for real stuff. And that for the moment probably means that they're missing something in their peg, but no doubt something they're planning to sort. So I have a proposal for illiquid assets in MakerDAO. So we can bung in tokens, we can do all this stuff, and there are good price feeds on these tokens. But what about if, let's say, £1 billion company wanted to borrow £100 million, it's a pretty safe loan, from the MakerDAO system. So the question is, how do you price this loan, especially if the company's not? I mean, there are quite a lot of billion-pound companies in circulation these days. Sadly, not AZTEC just yet. But if a company wants to borrow 100 million, it may not be very well known by the markets. So how could a CDP lend to this thing? So what you could do is you could say, okay, well, we don't know how to price this loan. Because bear in mind, in the MakerDAO system, there's going to be a stability fee, which is the cost of borrowing, associated with every CDP position. And MakerDAO doesn't know how to price this, and they shouldn't. They need to set up a system that allows them to lend to these companies, but where other people say, I'm going to stump up some sort of guarantee that this loan is fairly safe and priced well. So MakerDAO can sort of say, okay, well, we're going to set up a structure where we lend to the company of 5%, And we'll do it if the market provides us £10 million of guarantee. So £10 million of additional lost capital. And so the people who would now come in are those people working in Mayfair, or where do all the smart people work in Manhattan? Is it down by Soho? I can't remember anyway. So anyway, all these kind of hedge funds, they can come in and they can say, okay, I really think this loan is going to hold, and I'm pretty confident about the price of the value of the company. So I'm going to put up some stake. I'm going to put up some cash stake. But I'm going to charge you for that stake. So DeFi Fund 1 comes in and says, okay, I can bid 5 million at 1%. So 1% on the notional of the loan will be payable to me in exchange for my stake, but I'm going to lose this stake if actually something goes wrong with the loan. But they can't make up the full guarantee. We need to get to 10 million. So we keep going. So who's the next most competitive bid? Okay, it's DeFi Fund number 2. And they're putting up 3 million. They're going to take 1.5%. And finally, Fund 3 has got 3 million at 2%. So we can take 2 million of their 3 million, and we've got now our 10 million, we've got the 5 million, 3 million, the 2 million guarantees. And so what's now happening? We've got a 1.35% rate going to these funds who are saying, we're confident that this company is worth what you say. It's worth the billion that you say it is. So the risk on the loan is pretty small. We'll charge you 1.35% on the notion of the loan as a fee for our guarantee. And you can now generate quite sensible returns, because MakerDAO is now getting over 2.5% return on this loan. I know it doesn't sound very high by DeFi standards, but we're going to have to accept we're in fairly sort of rare times at this point. We're not going to be getting 8, 9, 10% out of these systems, or whatever. What's the stability fee now? Is it 15%, 14%? I think it's just come down again. And then you've got all these funds, which can be kind of decentralized DAOs or whatever, but run by people, or advised, should we say, by people who are experts, and they're getting 10%, 15%, 20% returns on their staked capital. So it's quite good for everyone. If they're confident in the price, they get a very good return, and if something goes wrong, they've provided an insurance guarantee. So that might be a way to get an illiquid asset, some kind of additional guarantee that makes MakerDAO feel quite safe about lending to something that otherwise it isn't an expert in, and retains its position as an abstracted tier 1 lending system. I'm going to flash through this. I've already really alluded to this. There are some quite interesting things that might happen in DeFi by virtue of the fact you can now program streams of money. And one is you could extend the notion of securitization to kind of things like sort of salaries and subscriptions and payment of rent and all these kind of things. Because suppose you've got a landlord and you need to pay £800 a month. The landlord might turn around to you and say, okay, well, actually, I tell you what, you give me a first guarantee on your £800 of rent a month, and actually, I'm not going to charge you £800 for that. I'm going to charge you $790 because I've got a better guarantee that I'm going to get the rent from you. So things like that, being able to program cash flows is essentially a way of securitizing and reducing people's risk with one another. So we might very well find, actually, we can just park our salary as collateral into a CDP and help support this price-stable token system. So I just wanted to really sort of flag that. It's not really sort of part of the flow of the talk. I want to quickly talk about what we're doing in AZTEC. And then I'm done. So AZTEC 1.0 is a ZK Lego kit. It's built with developers in mind who are building things like securities, payments, and it's a system, AZTEC, as you may be aware, of privacy. So you get confidential transactions. We don't yet have native anonymity, but you can get that with self-addresses if you implement them. We are, however, looking at some other technologies at the moment that will help us to provide that anonymity. Initially, we started as a credit issuance and trading platform, so my background's in credit. And so what AZTEC addresses today is quite classical financial assets, but tomorrow we'll hopefully be able to drop sort of essentially veils of darkness over smart contracts and allow more sophisticated logic in private. These are our proofs at the moment, so you'd compose these proofs, send, swap, income, mint, burn. So you'd use the income proof, for example, for a bond, for equities. You'd use the swap proof to build a clearinghouse, all that kind of thing. And AZTEC 2.0 will go into things like universal snarks. We just issued a thing called Plonk with Ariel Gabizon of Protocol Labs, who's ex-Zcash. And then the question is going to become, well, how do we do DeFi inside a system where we don't even know what nonsense is in these CDPs? You know, if I don't even know what's in there, how on earth do I know whether the system has enough assets to back a stable currency. And so actually what's going to happen inside ZK DeFi systems is you as a borrower, you're going to have to keep on reporting back to this system to say, blinking heck, okay, it's been 5 minutes and I've got to send you another proof because the collateral's fallen by 2%. Or so we mustn't sort of get ahead of ourselves. DeFi in more general ZK systems is going to be quite difficult to do because you're going to have to keep on proving to this paranoid system that the system isn't underwater. So it's going to become a more complicated thing to do, and I can't tell you that we've got a very sophisticated view on how that'll work. I'm sure these things will become automated at some point. But anyway, just alluding to that. Right. So I would like you all to sign up for our MPC. Who's aware of the Zcash Powers of Tau ceremony? Was anyone aware of that? Okay, so yeah, minority. When Zcash... I still can't say that. Zcash. When Zcash set up, it had to do a Powers of Tau ceremony, which is it's a kind of big computation amongst lots of disconnected parties. The reason you do this with ZK systems today is largely, it's not all true, but largely you use a thing called a reference string, which is a cryptographic number, which gets computed by all these people who you need to avoid. You want to avoid at least one of them colluding with all the others, and it allows you essentially to reduce the cost of doing private transactions on blockchains. So by doing this big computational ceremony in the 30 days leading up to the launch of the network, we can reduce the overheads, reduce the cost of getting privacy on Ethereum. So we're looking to launch privacy on Ethereum through the AZTEC cryptography engine at the end of October, and we need to do this first. So, oh, great, brilliant. So this shows a kind of dummy network that we built where we've got sort of servers around the world. My geography is not, wherever that is, Finland and various other places. This shows the path of our transcript going around the Earth. We can get up to 200 participants in this first relay phase, and then unlimited participants in the second phase, which is where we're building what's called the AZTEC Codex. But this is the system we're going to be using to set up the security of the network. Now, if you take part, you will get a T-shirt, and you'll have to download a piece of software. You'll have to run it for between 1 and 6 hours, depending on what laptop or hardware you have. I bought a rubbish MacBook, which supposedly was up to date, and it's going to take something like 5 hours on this thing. We haven't officially started the ceremony yet, but our participant 0 has already completed his step using another implementation, which is great. So there will have been 2 implementations used in this setup. And so I'll just explain what all this is. There's the QR code. Please snap away if you feel inclined to take part in this ceremony. These MPC ceremonies, they don't come around too often. There's one for Zcash. There have been 2 or 3 others, and I think the Ethereum Foundation is setting up one. But they're quite rare events, and we'd love you to sign up and tell your friends in as many remote locations as you can possibly find. So as far away, please, from London as possible. In particular, we're finding actually our blind spots so far have been Africa, South America, and Australasia. So please do get friends to sign up from there. And that's it. Thank you very much.